Let me ask you something that might feel a little uncomfortable. Imagine you've spent the last 30 years of your life paying off your mortgage. Every single month, without fail, you made that payment. You skipped vacations, you drove the same car for a decade. You told yourself it was all worth it because one day, you'd own your home. No debt, no rent, just yours. And then that day finally comes. The mortgage is paid off. You sit in your living room, look around, and feel that deep sense of satisfaction. You own an asset, a real one, something you can see, touch, and sleep in. Except, what if I told you that for most of those 30 years, your house wasn't really working for you the way you thought it was? What if the thing you were told was your greatest financial achievement was quietly doing something very different to your wealth? This is one of the most controversial ideas in personal finance, and whether you agree with it or not by the end of this video, I guarantee you'll never look at homeownership the same way again. Here's the belief that almost everyone grows up with. Renting is throwing money away. Buying a home is building wealth. A house is the best investment you'll ever make. It's told to us by our parents, by bank ads, by real estate agents, by basically every cultural signal around us, and it feels completely logical on the surface. You pay rent, that money disappears. You pay a mortgage, you're building equity. Simple math, right? This idea is so deeply wired into how we think that questioning it almost feels irresponsible, like you're saying something dangerous. But here's where it gets interesting. Robert Kiyosaki, the author of one of the best-selling financial books of all time, made one idea famous above everything else. He said your house is not an asset, it's a liability. And when people first heard that, a lot of them got angry. Some still do, because it goes against everything we were taught. So before you dismiss it, let's actually understand what he meant. Because the real lesson isn't that you should never buy a home. The real lesson is about how you think about money, and that lesson is worth far more than the house itself. Let's start with a simple question. What is the difference between an asset and a liability? Most people define it like this. An asset is something you own. A liability is something you owe. And in that world, a paid-off house is absolutely an asset. But Kiyosaki defined it differently, and this is where the idea gets powerful. An asset is something that puts money into your pocket. A liability is something that takes money out of your pocket. Read that again. An asset puts money in, a liability takes money out. Now, let's apply that to your house. Every single month, your house is costing you money. There's your mortgage payment, obviously, but there's also property tax, which in many countries you pay every year regardless of whether you have a mortgage or not. There's homeowner's insurance, there's maintenance, the roof that needs replacing, the plumbing that breaks, the paint that peels, the water heater that decides to retire on the coldest day of the year. There's the cost of furnishing it, renovating it, upgrading it. And here's the number that surprises people. Over a 30-year mortgage, the average homeowner pays almost double the original price of the house by the time you add interest alone. If you bought a house for 40 lakhs, you might end up paying 70 or 75 lakhs total. That gap? That's money flowing out of your pocket every month. Your house is not sending you a paycheck. You are sending your house a paycheck. Under Kiyosaki's definition, that makes it a liability. Now, at this point, your brain is probably pushing back. It's saying, but my house is going up in value. That's my investment growing. And this is where we need to talk about one of the sneakiest tricks your mind plays on you when it comes to money. There's a psychological bias called the endowment effect. It basically means that we assign more value to things simply because we own them. The moment something belongs to us, it becomes more precious in our minds than it actually is in reality. This is why people selling their homes almost always think their house is worth more than buyers think it is. They've lived there. They have memories there. They painted that wall themselves. So in their mind, that house is worth a premium. But the market doesn't care about your memories. And here's the uncomfortable math that most people avoid looking at. Yes, house prices generally go up over time, but when you adjust for inflation, meaning when you look at real returns after accounting for the fact that money loses value, housing has historically been a much weaker investment than people think. One famous analysis by economist Robert Shiller showed that over a century, U.S. housing prices, in real terms, grew at roughly 1% per year on average. The stock market, over that same long period, has returned somewhere around 7 to 10% per year in real terms. So while your house might go from being worth 40 lakhs to 80 lakhs over 20 years, you have to ask, how much did you spend on it during those 20 years? How much in maintenance, taxes, interest, and upgrades? When you total all of that up and compare it to what you actually made on the sale, the return often looks very different from what people expect. There's another psychological trap at work here too, and it's called the illusion of equity. When people build equity in a home, meaning the value of their house minus what they owe on it, it feels like wealth. And in a technical sense, it is. But it's wealth you cannot easily use. It's locked up. You can't spend it on groceries, you can't invest it, you can't use it for your kids' education without taking out another loan against the house. The money is there, but it's frozen. It's like having a savings account that you can only access by borrowing from it. And this creates a really interesting trap that many middle-class families fall into. They spend their entire working lives building equity in their home, believing they're becoming wealthy. But all of their money is sitting in one illiquid, non-income producing asset. They're what people call house rich and cash poor. The house looks impressive on paper, but it's doing almost nothing for their day-to-day financial freedom. Compare that to someone who invests in assets that actually pay them back. Stocks that pay dividends, rental properties where someone else is paying the mortgage, a business that generates monthly income. Those assets follow Kiyosaki's original definition. They put money into your pocket regularly, without you having to sell them to access that value. That's the real difference. Not just ownership, cash flow. So what should you actually do with this information? First, let's be clear about something important. This video is not telling you not to buy a home. Homeownership has real benefits. Stability, community, the freedom to paint your walls whatever color you want, and in many markets, over long periods, it does build meaningful wealth. The point is not to abandon homeownership. The point is to stop treating your primary residence as your financial strategy. Because here's what happens when people believe their house is their greatest asset. They put all of their extra money into their mortgage. They renovate endlessly, telling themselves they're adding value. They feel financially secure because their net worth looks good on paper, and in the meantime, they never build a portfolio of assets that actually generate income. They never invest consistently in the market, they never buy anything that actually pays them. And then, one day they're 60, their house is paid off, they have real estate wealth on paper, but no cash flow, no passive income, no financial freedom, just a nice house and not much else. The shift in thinking is this: your home should be a place you love to live in, but your financial future should be built on assets that work for you while you sleep. Assets that generate income, grow in value, and don't require you to sell them to benefit from their value. Ask yourself honestly, outside of your home, what assets do you own that are putting money into your pocket right now? If the answer is not much, that's the real conversation to start having with yourself. The goal of building wealth is not to have an impressive balance sheet. It's to reach a point where your money is making enough money that you no longer have to trade your time for every rupee you earn. Your house by itself will never get you there. Here's the thought I want to leave you with. Most of us were handed a financial roadmap by the generation before us. Study hard, get a good job, buy a home, pay off the mortgage, retire. And that roadmap isn't completely wrong, but it was designed for a different world. A world where a single income could support a family, where pensions were guaranteed, where the cost of living didn't outpace wages. That world is mostly gone. In this world, financial freedom requires you to think more carefully, to question things that feel obvious, to look at money not just through the lens of what you own, but through the lens of what your money is actually doing for you every single day. Your house might be the most expensive thing you ever buy. That doesn't automatically make it the best thing you ever do with your money. The wealthiest people don't just own things, they own things that pay them back. That's the game, and the sooner you start playing it, the more of it you get to win.